Ryan Detrick is the chief market strategist at the Carson Group. It's great to see you, Ryan. And, you know, there's been what I've picked up of kind of you start to get the weekend think pieces. Are people going, you know, just be careful? I think Bill Gross had something to this effect, too, where he said, look past Meta and Microsoft, and there's, you know, less to love about the market. And I know he's often pessimistic, but give some reassurance to those who are concerned that we came back a little bit too quickly here.
Yeah, Kelly and Brian, thanks for having me back. Appreciate it. Happy Friday, everyone. So listen, the longest win streak, obviously, since 2004, in all likelihood here. Well, I was thinking some things to talk about. One thing that's interesting, and you guys might like this. We had a 19% near bear market. We all know that. Over the top negative sentiment. No, the economy is not perfect. It's slowing down, but it's not nearly as bad as we thought this time 3 or 4 weeks ago. But as of right now, we have corrected more than 50% of that near bear market. When I went back in history, when you have these near bear markets like we just did, once you correct 50%, only once have we rolled back over to make new lows. And as everybody knows, that was in 2022. The other like 10 times before that, we didn't make new lows. Listen, this isn't perfect. I get it. We can get in the weeds of it. But listen, there's a lot more positives out there. One more quick one here. You know, market breadth has been so strong, even on the 19%, near bear market. If you look at advanced decline lines, they really held in there. Right now, this second, the advanced decline line on the S&P 500 sitting at an all-time high. Usually, the way I learned it a long time ago, breadth leads price. I get the headlines, I get the worries, but this is a healthy market. And I'll tell you what, the lows of the year are probably in, and the bulls might have a little more fun.
All right. You said a lot, and we're glad that you're here. And we don't know where we're going. Ryan, to be perfectly blunt, you're optimistic, and I hope you're right. A lot of our viewers and listeners hope you are right. Go back to that data you just rolled out. So when we have this kind of violent correction, like we fall and then we come back, 100% of the time, the markets are higher a year from now, correct?
Yeah, that's right. When you have
that's a lot of percent, 100.
It's pretty high. Now, listen, the statisticians would say it's a small sample size, and I would agree. If there were more examples, Brian, we would use it. But that's what we've seen, these violent corrections. And at night, I know, Mike Santoli pointed this out, 19% for whatever reason in 1976, 78, in 1990, 2011, 2018, we had 19% near bear markets. Intraday, you clipped it. Everyone gets all bared up, and then you hit the low. And we're there again, Brian. And that's just, some positives, I guess, things to think about here.
The weirdest thing about this, and you referenced there's one time where we didn't get the stat that you referenced, that was 3 years ago, 2022. It is amazing that we forget the market fell 25% top to bottom intraday in 2022, lost 1/4 of its value. It's up big since then. But yet it got almost no attention, probably because it was slow bleed from January to October, just kind of like just a death by 1,000 cuts. This one, very different. How do we compare 2022, which got almost no attention for some reason, to now?
Well, if you were there, you remember it. Maybe we need to have you and Howard.
I was hosting specials Sunday night.
We were doing a lot of those together. I think you need Howard Lutnick on more. You've had the market rally a lot since you and Howard talked about things. But listen, Brian, what happened in 2022? All right. The whole globe sold off. What are we seeing now? Like U.S. and India are the only two markets really down. The rest of the globe has been really strong this year. So that right there is one major difference. Also, bonds did terribly in 2022. So diversified portfolio, forget it. It was a rough year. Bonds have done okay this year. We all know gold has done well. So some of those diversifiers this year are doing well. That's a really good I work with financial advisors every day, right? That's a great reminder to financial advisors and their clients why we preach to stay diversified, why you don't chase a shiny object, why you diversify, why you rebalance, why you do these kind of boring things, because then you have a year like this, and it wasn't fun this time a couple weeks ago, but being diversified, it, honest to goodness, hasn't been as bad as it seems as if you're in only the Mag 7, which we have not been.
I know, Brian, this isn't what you kind of, spend your days and nights poring over, but we talked last hour to Bill Smead, who's out at the Berkshire Hathaway meetings. That'll be fun to listen into tomorrow. And we all know about the Buffett indicator, right? The measure of, I think it's total market cap to GDP. That continues to just climb and climb and climb and climb and climb. So I take your point about staying in the market and building long-term wealth in everything, and that's what we do. But do you take a metric like that and ever worry about it? Or at some point, is it just a data point that's going to fall by the wayside?
Yeah, I think Mr. Buffett himself has kind of said that he's not so sure if it's quite the same indicator. Maybe we'll find out this weekend. But I will say this, Kelly, along those lines. Yeah, tech has been pricey. We came into this year, tech has been pricey. Parts of the U.S. market are clearly pricey, but there are a lot of other parts that aren't. Small caps, mid caps, financials, industrials, they're not as stretched. Those are some value. Let's call it value. Value and low volatility, two areas we've liked. They've done pretty well this year. So if someone doesn't want to buy the pricey things, I couldn't blame them. There's a lot of other parts, though, that are cheaper, and that's I think important for investors to always remember those things. I'm sure Bill probably pointed that out too. That's something to think about.
No, he did, and he pointed out this irony, right? Like,
yeah,
the company Berkshire has all of this cash. Investors are getting a little itchy because they go, okay, in the long, T-bills are fine for now. But you got to buy. And Warren said, I remain committed to equities. But what companies or what publicly traded or otherwise can they buy to move the needle at this point? And if you don't jump in when you get these little market opportunities. Yep. Is he waiting for a much bigger pullback, thinking that things are, still dramatically overvalued here? I don't know.
Yeah, it seems like he is. Let's not forget, he's made some really big bets in Japan. He's made some big bets around the globe. So he's looking around at some of these other parts that are a little bit cheaper. I know one more quick one here. Everyone talks about sell in May, go away. Just know this. The last 10 years, May's been higher, 9 of them. And these next 6 months, which are usually fairly weak, have been higher 8 out of 10 times. So don't just blindly sell a May, go away. In fact, we think we'll probably get a pretty good rally, guys, in May and into the next 6 months, honestly.